We don't often talk about the taxation of mutual funds because we don't own a lot of mutual funds inside of our client accounts over here. We use mostly exchange traded funds and individual securities to get whatever exposure we're looking for. And exchange traded funds have different tax implications or tax consequences than mutual funds. But because of something that has happened this year with funds having net redemptions, I wanted to bring this to your attention in case you are an investor that has mutual funds inside of a taxable account. So again, this doesn't apply if you have mutual funds inside your 401k or IRA, but if you're an investor that has mutual funds inside of a taxable account, this is something you're going to want to be aware of. So this year in particular, all the 25 largest active stock mutual funds have had net outflows of approximately $4 billion. People are taking their money out of those mutual funds. This could have big implications from a tax perspective because the thing about mutual funds is that if you own a mutual fund from day one up until the day before it makes its tax distribution and then you sell, you are not responsible for any of that capital gain distribution that the mutual fund attributes at year end. However, if you are an investor that bought the day before the mutual fund distribution, tax distribution, and going forward, you become responsible for the tax hit for the entire year before you owned it. And since stocks have had a very good run since the COVID lows of 2020, a lot of these funds have a lot of unrealized gains that they are likely going to distribute. I bring this up because, as it shows over here, you could be hit with a very, very sizable tax bill, even if you were just a buy and hold investor of these investments. So the tax planning opportunity here is to take a look at the funds that are inside your taxable account, and they will give you an idea of what the proposed taxable distribution or the tax distribution is going to be at year end. If it is going to be a big hit and you are better off selling before they make that distribution, you need to do so before they make their tax distribution. If you look at it and you're better off continue to hold despite the tax distribution, well, then continue to hold and you'll just be responsible for paying the tax at year end. But this is just an area I wanted you to be aware of, that this year may have higher tax distributions from these mutual funds than you've seen in the past. And again, like anything else, you can plan for it as long as you're aware of it. If you have any questions about this or anything else, just let us know. I'll be happy to help. Thanks. Have a great day.